Right now, some people are getting paid, not because they worked, but because they own the right stocks. That's dividend investing. And in the next 10 minutes, here's exactly what you're going to learn. No fluff, no filler. Let's get straight into it. And if this kind of content is useful to you, hit subscribe and the bell right now. It genuinely helps this channel grow, and we drop content like this every week. All right, let's start at the foundation. What is a dividend? When you buy a stock, you become a part owner of that company. Some companies, and especially big, mature, profitable ones, take a portion of their earnings and distribute it directly back to shareholders. That distribution is called a dividend. Now multiply that across multiple companies, across thousands of shares, over years of reinvesting. And suddenly you're not just investing, you're building an engine. Dividends can be paid monthly, quarterly, or annually depending on the company. And the beautiful thing? You don't have to do anything to receive them. The money literally shows up in your brokerage account. Now here's where most people mess up. They see a high dividend yield and they just buy. That is a trap. Let me show you the real metrics you need to understand. Dividend yield tells you what percentage of the stock price you'll receive back each year in dividends. For example, if a stock costs $100 and pays $4 per year in dividends, the yield is 4%. A yield that seems too good to be true. It often is. Companies in trouble sometimes have high yields because their stock price has crashed, not because they're thriving. This is called AI, and it can cost you everything. The payout ratio tells you what percentage of a company's earnings are being paid out as dividends. Formula: dividends, earnings, per share x 100. You want companies that pay dividends and still have money left over to grow, innovate, and survive downturns. A payout ratio above 80% means they're barely keeping up. A cut could be coming. This is arguably the most powerful metric. How much has the dividend grown over the past 5 to 10 years? A company consistently growing its dividend by 7 to 10% per year. That's a sign of financial health. That's a sign of management that respects shareholders. Growth beats static income every time when you're thinking long-term. How long has the company been paying dividends without interruption? Companies that have paid and increased dividends for 25+ consecutive years are called 50+ years. These are the royalty of the dividend world. There isn't just one way to do this. There are 3 main approaches, and the right one depends on where you are in your investing journey. You target stocks, REITs, real estate investment trusts, or business development companies with yields in the 5 to 9% range. You're optimizing for cash flow today. The trade-off? Less growth potential. You're trading rocket fuel for steady gasoline. Flash as example sectors on dark HUD. You target companies with lower yields, maybe 1.5% to 3.5%, but whose dividends are growing rapidly. You're playing the long game. In 10-15 years, the dividend you receive on your original investment could be 10%, 20%, even higher, because the company keeps raising it. This is what most serious dividend investors do. A core of stable dividend growers for the long haul. A smaller position in higher yield instruments for current cash flow. You get income and growth. You build and live. Now let me show you the most underrated weapon in the dividend investor's arsenal. It's called the DRIP, Dividend Reinvestment Plan. Instead of taking your dividends as cash, you automatically reinvest them to buy more shares. Those new shares generate more dividends. Those dividends buy more shares. It compounds, like interest on interest, but with real equity ownership. On dark HUD, DRIP line shoots higher. Let's run an illustrative example. And I want to be really clear here, these are assumptions, not guarantees. $10,000 invested, 4% starting yield, 6% annual dividend growth rate, with DRIP fully turned on. Over 30 years, the annual dividend income generated on that original investment could exceed $50,000 per year. The point isn't the exact number. Markets vary, dividends get cut, life happens. The point is that the direction of compounding, when left alone over time, is relentlessly upward. That's the math. And that's why starting matters more than timing. Albert Einstein reportedly called compound interest the 8th wonder of the world. The DRIP is compound interest applied to equity ownership. Okay, you understand dividends, you understand the metrics, you understand the strategies. Now, how do you actually build a portfolio? Don't put all your eggs in one basket. Dividends aren't just for one industry. Consumer staples companies sell products people buy no matter what happens in the economy. Utilities pay consistent dividends because people always need electricity. REITs are legally required to pay out 90% of taxable income as dividends. Healthcare companies serve aging populations that aren't going anywhere. Diversification means that when one sector gets hit, and they all get hit eventually, your entire income stream doesn't collapse. Dividend ETFs, exchange-traded funds, are baskets of dividend-paying stocks managed automatically. They give you instant diversification, low fees, and professional curation. Think of them as a starter kit for dividend investing. As your confidence and knowledge grow, you can layer in individual stock picks. Consistency beats timing every time. Don't wait for the perfect moment to invest. Set a fixed amount, whatever you can afford, and invest it on the same day every month. You'll automatically buy more shares when prices are low and fewer when prices are high. This is called, and it removes emotion from the equation. Track every dividend payment, watch the income grow. This isn't just about motivation, though seeing your passive income rise every month is incredibly motivating. It's about making sure your portfolio is performing as expected and catching problems early. Let's talk about what not to do, because these mistakes can set you back years. We already touched on this, but it bears repeating. An abnormally high yield is a warning signal, not a gift. It almost always means the stock price has collapsed, the dividend is unsustainable, or both. Do your homework before getting seduced by a big number. In the UK, one of the most powerful tools available to dividend investors is any dividends you receive inside an ISA are completely tax-free. No income tax, no dividend tax. The money is yours, in full. Outside of an ISA, you get a dividend allowance each tax year, but beyond that, dividends are taxed as income depending on your tax band. The ISA wrapper removes that problem entirely, and it's something US investors don't have access to in the same way. If you're in the UK, use it. For investors outside the UK, dividend taxation varies. Some dividends qualify for lower capital gains tax rates, others are taxed as regular income. Always understand the tax treatment of every position you hold, and work with a qualified professional if needed. Dividend cuts happen. Companies face hard times. Always check the payout ratio, debt levels, and earnings trends of every company you hold. A dividend that looks rock solid today can disappear tomorrow if the company over-leverages itself or hits a bad earnings cycle. This is probably the most common mistake. People invest for 3 months, see modest results, and give up. Dividend investing is a long-term game. The compounding, the drip effect, the dividend growth, they take time. The investors who win are the ones who stay in the game long enough to let the math do the work. Here's what we covered today. Dividends are real money paid to you for owning shares. The metrics that matter: yield, payout ratio, dividend growth, and consistency. The 3 strategies: high yield, growth, or hybrid. The secret weapon, the drip: how to build, diversify, use ETFs, contribute consistently, and track religiously. And the mistakes to avoid at all costs. Dividend investing isn't about getting rich overnight. It's about building a system, a machine that generates income for you while you sleep, while you travel, while you live your life. The best time to start was 10 years ago. The second best time, right now. If this video opened your eyes, did me a favor, smash that like button right now. It tells the algorithm that this kind of content matters, and it helps us reach more people who deserve to know this information. And if you haven't already, subscribe and hit that notification bell. We break down wealth building strategies every week in a way that actually makes sense. No jargon, no gatekeeping, just real knowledge. The journey to financial freedom starts with a single decision. Make it today. I'll see you in the next one.